Okay, everyone. Our next presenting company is HighPoint Resources. So HighPoint may not yet be a familiar name with you, but HighPoint is a combination of Bill Barrett, who should be a familiar name with you, and Fifth Creek Energy. So HighPoint is based here in Denver. They're focused on exploiting their acreage in the DJ Basin. Here to present the HighPoint story is Scott Woodall, their president and CEO.
Thank you, and I appreciate everybody's attendance today. You know, we think we've got an exciting story to tell, and so I kind of welcome the opportunity today in front of such a big crowd. First off, we have our normal forward-looking and cautionary statements. Seems like we've added to the list here a little bit, Larry, but anyway, I'll leave those for you to read. And we'll kind of do a little intro about the company. I'll do a little corporate overview. We'll talk about the assets. We'll talk about the balance sheet and the financials, and then I'll wrap up with a few closing comments. Starting first, a little bit is like HighPoint Resources is a new company formed in the first quarter of 2018. It's the result of the Bill Barrett and Fifth Creek Energy combination that took place in, like I say, March of this year. 100% focused on the DJ Basin, and I'm excited to talk about our assets, and I'll run through those with y'all. We obviously got a new stock symbol listed there and a new web address for your reference. Starting first with the company overview. This is kind of some key points of the way I kind of think about the company a little bit and really strategically what the company is trying to do. So it first started in that upper left-hand box of trying to build an acreage position. And you'll see in the following slides, we had more than 150,000 acres, very contiguous position, really all suited for extended reach lateral development. So it really kind of started with that position. You'll see as I kind of go through the presentation, it has very high oil cuts, which lead to very high economics, great capital efficiency, and an overall margin. Secondly, you kind of move around this thing and you move to the upper right quadrant there where we talk about our technical expertise. It's what we think we really do well, and you'll see the application of that technology. Like I said, really since 2014, we have drilled nothing but horizontal 2-mile length laterals, and we think we do it pretty well. And you'll see cycle time improvements. You'll see production year-over-year results. You'll see EUR results year-over-year improving. It's really what we think we do well in the legacy Bill Barrett company and what we plan to do on the newly acquired Fifth Creek acreage position. Obviously, in the bottom right-hand corner, you have to have a balance sheet. You have to have plenty of liquidity. And I think you'll see over the last several years why we've built this acreage position and established that 150,000-acre position. We did it in a time of very challenging commodity prices, but we also reduced our debt by more than 50% and have very attractive liquidity and debt leverage metrics. And then in the bottom left corner, obviously, you want to continuously improve, and you have to measure those results. And you'll see in some subsequent slides where we have some of the strongest margins in the basin, some of the strongest capital efficiencies. And so really think that we're off to a great start, and I'm very proud to be a part of the new organization. Talking about that position, so here is the position of HighPoint Resources, two very contiguous acreage positions. The first being up at the Hereford Field, which sits on the Colorado-Wyoming border, a little over 86,000 acres. You can see the contiguous nature of that position. The other position being the Northeast Wattenberg position, a little more than 64,000 acres, and that very contiguous position as well. With overlaying our geologic footprint and our assumptions on spacing, we have more than 2,800 locations, of which 95% of those will be developed with extended reach lateral wells. As I said, we have very high oil cuts. The Northeast Wattenberg position is about a 60% oil cut. The Hereford position is about an 80% oil cut, which leads to very robust economics. As you can see at our base assumptions at $55 crude prices and our base assumptions for D&C and for EURs, generate those rates of returns you see there of a range of 56% to 78%. Obviously, we think we're a pretty strong technical company. We have all the geologic data, seismic, petrophysical models that really support that location inventory and those rates of returns. And then we'll talk a little bit about midstream as I kind of get into each of the assets here in a few minutes. Talking first about the last quarter highlights, a couple of comments that I'll make with the bullets that you see here on this slide. First off is the integration of the two organizations into the two different companies. So this transaction, as I said, closed in March, and I really think the back office did a tremendous job of really kind of rolling the two companies together from, email addresses, financial statements, new office locations, really a big rollout associated with that, and I think our back office really did perform extremely well. But probably more importantly to the investment community is within 3 weeks of doing the Fifth Creek transaction, we had equipment running in the field. So we had one drilling rig up and running in the field. We had one frac fleet up and running in the field. Subsequently, in June, we've added a second rig into the new Hereford assets. So really, when you think about doing a combination of this size and scale and to combine it so quickly and smoothly, and like I say, in leading to actually activity in the field, I think the whole organization has stepped up and really performed at a very high level. Continuing with some of the second quarter highlights, I'll draw your attention to a couple of things there. So, the oil sales volumes, you can see Q2 18 over 2Q 17, a 67% increase in oil volumes. You can see really the step function change that our company is going with. You follow that with the next line there, the EBITDAX growth associated, second quarter over second quarter 2017. You can see nearly a 72% increase. And then we end the second quarter with still cash in the bank, a little bit more than $100 million, and an undrawn credit facility. So really a pretty strong quarter all the way around in the second quarter of 17. Here's a slide that I think we've had in our presentation for, 2 or 3 years with a legacy company. It carries forward. We publish this after all of our peers report quarterly results. This is the second quarter of 2018, and you can look at the margins that we do compared to the rest of our peers. And we've done this, I think, every single quarter, and I think we're somewhere between 20 and 30% stronger than the rest of the people in the DJ Basin. It really comes from a couple of things. It comes from me highlighting those high oil cuts, the 60% and 80% oil cut really leads to this margin, as well as just our overall cost structure and the overall differentials that we have in the basin. But it's something that obviously we're pretty proud of and think that our team is doing a great job. We talk a little bit about what we're trying to do in 2018 and 2019. As you kind of picked up on my second quarter recap, the company is situated for a pretty high growth trajectory over the next several quarters and over the next several years. But really, it's just kind of doing what we've been doing the last several years. So we had been running 2 rigs in 2017. We're merely just added the 3rd rig into the Hereford position, and it generates those type of cash flow and EBITDA growth numbers you saw in the Q2, and you'll see it again when I talk about 2019. As we kind of continue down that path, you'll see the metrics grow pretty substantially. And then what it does for us also is it continues to improve our credit metrics, and you'll see that here in a second. We're just kind of adding the 1 rig. The quality of the assets and the generation of that growth drives those debt metrics down to below 1.5. Talk about our guidance for the remainder half of 2018. Is really still pretty strong growth trajectories. As you can see there, we're going to spud about 120 to 125 wells in 2018. We'll be able to pay for that primarily with cash on hand and internally generated cash flow. And then you can see the sales volumes expected for the full year 2018 of 10.5 to 11 million barrels. And then you can look at the outlook over there in the bottom right-hand corner, where we expect sales volumes to be between 18 and 20 million barrels for 2019. And there again, that's just maintaining the same activity levels where we are today. The number of wells goes up to 150 just merely because we had 2 rigs running in Q1, and we anticipate in 2019 to have 3 rigs running the entire year. And then that last statement there in the box on the right there, we can see we expect to be cash flow positive in the second quarter of 2019. So a pretty significant accomplishment and something that we're looking forward to as well. We talk again about the production. The blue in this production, this is 2018, 2019 production. You can see the legacy position of the Northeast Wattenberg growing. It's a little bit more than 40% growth during this time frame. And then you can see as we get activity up and running, as I said, we brought in the drilling rigs in April of this year into the Hereford asset. You can see the growth trajectory associated with the Hereford asset and its contribution as it starts to kick in the second half of 2018 and 2019. We'll jump into the assets a little bit more detail. Here is the portfolio. Again, we are focused, exclusively on the Niobrara and the Codell. In the Northeast Wattenberg, we drill the Codell B and C, and a little bit of A. And up in the Hereford asset, we'll be drilling the Niobrara B and the Codell. As I mentioned earlier, there are lots of geologic information and lots of geologic data across the entire acreage position that makes us feel very comfortable with our petrophysical models and with our EUR assumptions and planned activities for the next several years. The other part that we highlight quite a bit as a company is when we started to acquire acreage in the DJ Basin and kind of reposition the company from a natural gas company to an oil company. We really wanted to be in a position to where we could control our own destiny and be able to control the pace of development. The previous organization really was largely on federal lands, and like I said, it was kind of a natural gas portfolio. We wanted to be on private lands, and we wanted to be about as rural as what you could get in Colorado. And if you look in the bottom left-hand corner, you can see those are actual pictures of some of our sites in Colorado and some of our activity in Colorado. And if you look on the slide on the right, that's a population density map that you're seeing there, with the blue being the population density in the state of Colorado. And then you can see where our assets lie. So we're about as rural as you can get and about as high oil cut that you can get, and is really why we selected this position and why we continue to operate in this position, and that we can drive our pace of development by getting timely permits and executing with our mineral landowners as well. Starting here with the Hereford field, we'll talk about a couple of things. A little bit more than 86,000 acres in that field. About 1,200 undeveloped locations. And like I said, that's combinations of Niobrara, B, and Codell wells. Spacing is something that we're going to continue to address as we are up and running in the field. But I think what kind of people forget a little bit is why there's only been about 10 extended reach lateral wells drilled by the previous operator. So in 2016, 2017, there's more than 62 one-mile length horizontal wells that have been drilled across the acreage position in 2009 and 2010. So it really sets the stage for the geologic understanding and to be able to put together that geologic and reservoir model. As we look at the current recent activity, like I said, that started in April, there were 9 previously drilled uncompleted wells on 3 three-well pads associated in the field. In April, we went out there and completed those 9 DUCs. They have come on kind of staggered. One pad of 3 came on in May, the second pad came on in June, the third pad coming on in July. The May pad has been on maybe about 60 days or so, and seems like it's trending very well. We're pretty excited about how we're doing those completions and those flowbacks. We've already drilled the first drilling and spacing unit. That was a 10-well drilling and spacing unit, and it is currently being completed. And then we are on 2 additional drilling and spacing units there that you can see labeled there by the number 5. You can see we're right in the heart of the field, and we're just drilling side by side. The natural gas processing plant and infrastructure sits right there, and really just to minimize cost associated with infrastructure, we're just drilling right there kind of side by side, and expect to have results out for the third quarter call in November on both of the 9 DUCs and potentially on the first 10 well DSU. We've already seen quite a bit of impact from the organization. As I said, what I think we've done well as a company is to drive cycle times, drive costs, and drive the things within our control. This is a slide that's talking about the new Hereford asset, and activities, I said, just started in April, and you can see some of the results by doing a continuous operation and doing a contiguous tackling of the acreage position. You can see the DUC costs were 29% completion costs below what we did in 2017, and then you can see, look at the cycle times down there, pretty good improvement in cycle times, and also a 17% reduction in cost per foot in the drilling. And like I said, that's up and running just in the first few months. So we're pretty excited about the way we got started. Probably most of us in the room been parts of mergers and acquisitions, I think, before, and it seems like you always kind of stumble a little bit out of the gate, or maybe you don't quite meet up to all your expectations. And like I said, I think the team is really performing at a really high level, and I think these numbers are starting to show that, and I expect them to continue to trend favorably over the next several quarters. Moving to the Northeast Wattenberg position, there again you can see the contiguous nature of the position. There's one rig that is running there. Still very attractive economics. When we take our average EURs and our average drill and complete cost, a 56% rate of return at $55 commodity prices. So really pretty strong, robust economics associated with the legacy position as well. We talk about kind of that continuous loop of what you try to do as a drilling and completion of your assets. And I think this slide is one of my more favorite slides. So what this is a slide of, it's the wells that we drilled in 2015, their cumulative production for the first couple of years, compared to the wells that we drilled in 2016 and then in 2017. And this is exactly what you want to see. If you compare the results of 2017 over the results of 2015, a 48% improvement with like 16 months of production history here to date. So I think that just kind of shows how the team assesses what's going on, tweaks completions, and drives and improves results going forward. So pretty pleased with the way this slide goes. We've had this in the presentation for a few months now. We just kind of keep updating the months of production, and you can see it continues to track very well. Cycle times is another thing that we're pretty focused on as a company and as an organization. And as most of you know, cycle times really means cost. And it's something that we have improved on pretty strongly since 2014 to 2017. If you look at the bottom right-hand chart there, where we have driven cycle times. And when I'm talking about cycle times, I'm talking about not only drilling days, but completion days, days to drill up plugs, get things online. And you can see the strong improvements, a 54% decrease over this time frame in those cycle times, which leads to overall improved drilling and completion costs. This is exactly what we expect to do going forward in 2018, exactly what we expect to do in the newly acquired Hereford assets as well. We'll talk a little bit about gas processing and oil marketing. Starting first with the oil marketing, that first bullet there where you see the capacity in the DJ Basin of more than 650,000 barrels of oil a day. Current field production around 400,000 barrels of oil a day. So clearly there's excess capacity, which if you do not have firm commitments and haven't subscribed to firm marketing arrangements, you're able to enjoy very low differentials. As you see noted on that slide, the company's differentials for the second quarter in 2018 of $2.76. So pretty favorable from that standpoint. We have very favorable API, I say no long-term marketing commitments, and so we expect to enjoy these differentials for a period to come. I think we guide to like $3, but still think it's going to be very favorable for the next several years. In terms of gas infrastructure, it's been another topic in the DJ Basin as we've all faced some constraints in terms of gas the last several quarters or so. I think the company has done a great job in the legacy Northeast Wattenberg position to create some additional outlets for our gas. We currently have 3 or 4 additional outlets, excluding DCP, to be able to take our gas. That I think with the help of DCP's new newborn plant coming on in August and these other marketing commitments that we have made, we'll see our additional capacity raise about 70%. From where we were a few quarters ago. So I think it'll give us the flexibility to continue to do our drilling and completion program. The Hereford asset sits up there. It gets gathered by Summit. Summit has plans by the end of the year to have another 60 million a day of processing capacity up and working in the field. So really think that we've got a pretty diverse midstream opportunities in front of us to be able to go out and execute our 2018 and our 2019 plans. Moving to finance, I think the point of this slide is really there's just no near-term debt maturities. We have 2 outstanding bonds, one due in 22, one due in 2025. Really sit well from that standpoint. We're in the middle of redoing our bank credit facility, which we'll do an amend and extend here in the third quarter. But really, it's an undrawn facility as it sits right now. As I said, we ended the second quarter with cash in the bank. So really, I think fit pretty strong. You can see the improving debt metrics in the bottom right-hand corner, and we expect to be about a 1 to 1.5 time levered company at the end of 2019. And then, that last bullet, I'll reiterate that one again, that the way we see our D&C activities for 2018 and 2019 will be cash flow positive in the second quarter of 2019. We do hedge as a company and as an organization. It's something that we've done really since the company was founded, really just to protect cash flows. And so we think we have very robust economics at the current strip prices. We take advantage of that and we hedge. We typically hedge within the next 12 months, somewhere around 50 to 70% of our production. You can see that's about where we sit. If you look at 2018, 2019, pretty solid hedge position. So that's how I can speak with pretty good confidence that we will achieve that cash flow positive in the Q2 of 18 based on the hedge position and the anticipated production volumes that we have. And then we're just starting to build a 2020 position. So really just kind of sum up here a little bit. Hopefully I got 3 or 4 points across. One is the contiguous nature of the acreage position, the rural nature of the acreage position, and the high oil cut nature of the position. Hopefully I've demonstrated I think the company is able to go out and execute, and I think you can see that in the year-over-year improvements that we've made in terms of production volumes and in terms of our EURs. And then lastly, it's all kind of translated to also year-over-year improving credit metrics. So really think that the team is off and running, and we look forward to continue to grow our production and grow our EBITDAX and create additional shareholder value for our shareholders. Thank you.
Scott and Larry will be in the Platte River A breakout room to discuss more about the HighPoint story.